These instruments could as easily spark a financial crisis today as they did in 2008. Another financial crisis looms as world marks 10th anniversary of the Lehman Brothers collapse. The 10th anniversary of Lehman Brothers Holdings Inc. filing for bankruptcy on September 15, 2008 approaches. It was the biggest bankruptcy in recorded history, and it triggered the biggest financial crisis since the Great Depression. Has Wall Street learned its lesson? The answer is a flat no. It seems that others are vying to beat that dubious record because another bank or group of banks has accumulated astonishing amounts of derivatives leverage since 10 years ago. They are over-leveraged in derivatives. It's as if Lehman Brothers collapse and the millions of jobs lost and savings gone up in smoke has taught us nothing. Derivatives remain a thing. The 5 top American banks have continued to operate in the murky world of derivatives. 8 Group, LLC calculates that as of December 31, 2017, the top 5 banks held about $157.0 trillion in derivatives. That's at least 10% more than they did in 2008. And if that's not dramatic enough, $157.0 trillion is equal to twice the 2016 global gross domestic product of about $75.0 trillion. Citigroup Inc. owns the largest amount of derivatives among U.S. banks, at some $45.0 trillion. But, not to be outdone, the Germans over at Deutsche Bank AG have as much as $64.0 to $70.0 trillion in credit default swaps derivatives. That's about the size of the world's economy. These numbers should make you uncomfortable. Just as in 2008, all it takes is a single error, or perhaps someone observing that Deutsche Bank's new strategy of focusing on Europe puts it onto a direct path of collision with a Eurozone black swan scenario to trigger a global financial crisis. The obvious question might be, why would bankers fail to consider, let alone appreciate, the risks that they are taking with other people's money, perhaps some of it yours? Such as the nonchalance that triggers a financial crisis, and the troubling numbers associated with the derivatives fail to describe the whole picture. The big banks are just the most transparent derivative holders. A myriad of smaller institutions and counterparties have spread the risk of these instruments to the population at large. The derivatives game has moved past the exclusive casino royal high-stakes poker scenario. More pedestrian online players have also been permitted to join. Few win and many more lose, literally. Consider that municipal governments in the United Kingdom tried to use derivatives in the 1990s to maximize their public finances until the practice was banned due to excessive risk. Italy borrowed the model, upping the ante and getting into significant trouble in the process. In the United Kingdom, a judge ordered a ban on banks and municipal governments' interest rate swap agreements. In Italy, judges adopted a similar decision in 2013. Likewise, in 2007, there were those who would announce the risks that the speculative bubble was about to burst. Few noticed, even if the financial crisis, which started in 2007 in the U.S., would end up affecting the world economy for a long time. 2008 financial crisis effects are still with us today. Most students of the 2007-2008 financial crisis agree that its cause was an excess of debt accumulated through the widespread use of high-risk mortgage, subprime, transactions, and related expansion of speculation. That speculation includes, among other instruments, the now infamous over-the-counter derivatives. These are the kind that buyers can acquire beyond the official and regulated markets, escaping the latter's attention and rules. Could it happen again? The crisis has passed in market performance terms. Stock valuations are at record highs, and, in many cases, they have surpassed logical expectations. Since 2009, the world's main financial markets have experienced the longest bull run in history. Yet, neither the real economy nor the conditions that produced the financial crisis in the first place have managed to achieve any kind of insurance against market risk. Regulators were supposed to have enforced mechanisms to exercise greater control over derivatives, especially the OTC variety. Yet, few have managed to navigate the murky waters of financial engineering such that there is a $600.0 trillion mystery to resolve. Dodd-Frank. President Barack Obama approved the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. It was intended to allow regulators greater ability to control derivatives trading. But regulations in banking and finance often tend to produce the opposite effect of their stated purpose. Prohibition in the 1920s led to higher demand for alcohol and the emergence of highly profitable organized crime syndicates. Dodd-Frank, as other similar laws, simply made legal what was shady or borderline illegal. Thus, while the law demanded that U.S. banks become more transparent about their derivatives activity by reporting trades and their specifics to the Commodity Futures Trading Commission, they were not obliged to disclose derivative holdings kept in offshore entities. Source: BID. That's one of the reasons that Deutsche Bank, perhaps the largest derivatives trader operating outside the U.S. market, has been able to continue offering derivatives with little or no U.S. disclosure. The Commodity Futures Trading Commission wanted to seal the loophole, enforcing a new rule that would have demanded subsidiaries of U.S. banks to disclose their entire derivatives exposure, while subjecting these to a new set of financial regulations aimed at reducing their profits and incentives. What are derivatives? Derivatives, as their name hints, are financial products whose value derives from another asset, which can be anything from a stock, a bond, or any number of assets. In simpler terms, consider a derivative as little more than a bet about the outcome of a future event or the future price of a commodity or asset. In more pedestrian practice, a derivative is little different than a bet at a horse race or an illegal boxing match. The idea has been to cover risks. For example, if I go long on a stock, I might purchase a derivative on that same stock, betting the price drops to hedge my bets. Derivatives are bets. But, more typically, derivatives are bets on the future price of a given commodity. Whereas, at first, even before the use of the term derivative, a baker might have locked in a price for flour for a specific period of time to facilitate his accounting the purchase price of wheat per kilo. The modern derivative does not feature an exchange of goods. It asks not the baker who buys the wheat in a derivative, rather, it asks the financial speculator. In the space of 20 years, the derivatives market involves hundreds of trillions worth of transactions. The reason derivatives can cause another crash is that the speculation that surrounds them has affected the price of hundreds of commodities. The people involved in producing the commodity, wheat, or whatever else, have no influence in deciding the price. In other words, derivatives represent the most arrogant face of the modern stock market, one that encourages an ever greater gap between the real and the make-believe economy of financial manipulation. That's why, in a stock market crash situation, the real economy is always so ready to implode. Economic slowdown looming. 40% of U.S. adults can't afford basic needs. Economic slowdown could be looming for the U.S. economy. We are told on a daily basis that the U.S. economy is fine, and that all is well going forward. If you talk about a looming economic slowdown, you are ridiculed. Well, the people doing the mocking shouldn't get too complacent. Sure, unemployment is at its lowest levels in a few decades. For proof, consider that U.S. gross domestic product grew at an annual pace of 4.2% in the second quarter of 2018. This was the best GDP reading in several years. The stock market also serves as proof of economic growth in the U.S. economy. It dates back to its all-time highs, with companies reaching $1.0 trillion valuations and having great-looking earnings. So no worries, right? Wrong, because an economic slowdown could be brewing in the U.S. economy. Understand that there are problems that nobody seems to be talking about. Sure, Amazon.com Inc. is on track to become the next trillion-dollar company, but that doesn't say much about the struggles of average Americans. Study says the U.S. economy could be headed toward an economic slowdown. Consider a recent study done by the Urban Institute, a think tank focused on economic and social policy research. This study is worrisome to say the very least, and its findings are something you shouldn't be seeing when there is economic growth. According to the study, in 2017, 40% of adults between the age of 18 and 64 said that they or their families had trouble paying for at least one basic need, be it food, healthcare, housing, or utilities. That's 4 out of every 10 Americans struggling to pay for the most basic necessities. Looking at this, if someone says there is economic growth in the U.S. economy, they may not be entirely correct. This looks more like an economic slowdown. After all, economic growth is when the general standard improves. More Americans on food stamps than the population of Canada. This is not the only troubling statistic that reveals that the economic growth we hear about daily may not be as robust. For instance, since we are talking about basic needs, as of May 2018, there are 39.3 million Americans using food stamps. To put it in perspective, this number is still higher than what it was just before the previous economic slowdown of 2008 and 2009 and higher than the total population of Canada. U.S. Economic Outlook. The U.S. economy isn't as strong as we are told it is. Don't listen to the noise. It is not a good indicator that Americans are struggling financially. In conclusion, ask yourself, how can the U.S. economy continue to go on without an economic slowdown, when average Americans are struggling to even pay for basic needs? Retirement crisis. 1 in 3 Americans have less than $5,000 in retirement savings. Study says retirement could be far-fetched for many Americans. Retirement may not be possible for Americans. According to the 2018 Planning and Progress study by Northwestern Mutual, a Milwaukee-based financial services company, about 8 out of 10 Americans are extremely or somewhat concerned about living comfortably in retirement. Sadly, the misery doesn't end here. There were a few more troubling findings in the study. 1 in 3 Americans have less than $5,000 in retirement savings. 1 in 5 Americans have no retirement savings whatsoever. 75% of Americans doubt that Social Security will be available by the time they retire. 55% of Americans believe they will have to work past 65. Here's the thing. This is just one of the many studies and surveys finding that many Americans' retirement could be in jeopardy. And there isn't much optimism going around when it comes to retiring. Beyond this, look at what is happening to various state and city pension funds. They are severely underfunded, with no good solution to the problem. How underfunded? Well, the American Legislative Exchange Council surveyed 280 state-administered pension funds, which, at the end of 2017, had underfunded liabilities of $6.0 trillion. Digging a little deeper. Based on the above, one has to wonder how big of an impact it could have on the U.S. government, not to mention the overall economy. You see, if the retirement woes continue, the U.S. government may have to step in. But unfortunately, it is facing financial issues itself. At the time of this writing, the U.S. national debt stands at $21.44 trillion. If the U.S. government has to bail out those looking to retire, it may have to borrow a lot more. It may require $6.0 trillion for state pension funds alone, which would bring the national debt to $27.0 trillion. And the national debt has to be paid off eventually. So it is not outside the realm of possibility for taxes to skyrocket immensely in the future. That is, unless the U.S. government tells its creditors that it can't pay them back. Similarly, Americans not having enough money to retire could have severe consequences on the U.S. economy. According to data from Bureau of Labor Statistics, older households, those run by individuals 65 and older, spend $45,756 per year, or about $3,800 a month. If we assume future retirees don't have much savings, how will they keep spending as much? This could drag down consumption a lot, which, don't forget, is roughly 70% of the U.S. gross domestic product. All I can say at this point is that there appears to be a big crisis waiting to happen. And the longer it is ignored, the bigger it will get.